Okay. Welcome back to the download, where we separate signal from very shiny, very noisy audio headlines. Today starts with iHeart bragging about a 24% podcast revenue jump. The question is, how much is mix shift optics and how much is real growth that actually moves EBITDA? When you line that up next to the Black Effect Podcast Festival, you can see the actual game. Turn community into a moat, then use events as leverage in talent negotiations and valuations. If you're a network GM, the headline is not, "We did a festival." It's, "We built insurance against talent churn while adding a new multiple-worthy revenue line." And it connects to the other story. Everyone suddenly thinks they're a video network. Plot twist, you're not. You're quietly wandering into TV economics while still pricing like a podcast. In segment 2, we'll pull apart the video pivot, YouTube's discovery math, the two-tier market of audio-first versus video-led shows, and why SAG-AFTRA's organizing push is the underpriced risk that could turn your little podcast into a line item in a much bigger talent deal. If you're not gaming this out, your competitors already are. Then we're shifting to sports. Jeff Passan's ESPN Omaha setup, Chris Williamson landing at CAA, men in blazers playing the long game. These are not nice podcasts. They're contractual glue that hold together talent ecosystems where IP control and cross-platform footprint matter way more than your download chart flex. Follow the money. Buyers ask about brand footprint first. Downloads are the third or fourth slide, if they ask at all. And we'll close by zooming out to the audience and monetization data that should finally end the podcasting is an experiment era. Lean into trend lines, vertical CPM gaps, especially in healthcare and pharma, and why podcasts are quietly becoming the default talk format for under 45s while linear radio keeps bragging about reach like it's 1998. The math doesn't math if you're still pricing this channel like Remnant. So here's your Monday morning checklist. 1. Are you overexposed to a single platform's video whims? 2. Do your talent contracts assume unionization never happens? And 3. Is your sales team calling the right categories, or just the comfortable ones? If any of those made you nervous, good. That means this episode is for you. All right, let's get into it. Segment 1. iHeart's 24 Pop, what the press release didn't say, and why the Black Effect Festival is a strategy deck, not just a party. We want to hear from you. Submit questions via the web form in the description or call 747-234-2678. Our AI assistant makes it super easy. Okay. iHeart drops Q4. Podcasts up 24% and everyone starts tweeting victory laps. So, does that move your valuation, or is it just a pretty quarter? If you're a mid-sized network thinking about a sale, you just got a new comp in your banker's deck. The question is whether it's real operating leverage or just mix shift away from a dying radio line. Total companies, basically flat. Traditional broadcast is soft, digital audio's carrying the story, and inside that, podcasting is the hero line. But let's be precise. Some of that 24% is just budget moving from spots and dots on AM/FM into the network's owned podcast inventory. That's not new money, that's repriced money. Higher CPM, better story for Wall Street, same advertiser pool. Great for margin, but don't confuse it with 24% category growth. Where it is interesting is the yield math. If iHeart can grow podcast revenue double digits while the broader scatter market's been choppy, it tells you they're finally sweating that flywheel. Broadcast promo, app inventory, and Salesforce scale all funneling into podcasts. This is what consolidation buys you. Smaller networks can't redirect a single Bud Light radio package into a podcast slate on Tuesday because they don't control the whole stack. Now, the other story I'm watching is the Black Effect Podcast Festival. On paper, it's an events line item. In reality, it's brand equity and talent insulation. You get Charlemagne, a curated slate of Black Effect shows, a couple thousand superfans, and suddenly you're not just a network, you're a culture platform.
Wow.
Try poaching that talent when the community literally gathers under your banner once a year. Here's what the press release didn't say. Festivals like that are defensive. They make it emotionally expensive for a host to take the Spotify check. Walking away isn't just breaking an ad deal, it's walking away from your own tentpole. The replacement cost of rebuilding that kind of affinity is way higher than a 7-figure events budget.
So, if you're a PE buyer, two things. One, you can't underwrite podcast revenue as experimental anymore when a legacy radio giant is leaning on it to offset softness elsewhere. And two, you have to start valuing community assets, festivals, newsletters, discords, as retention infrastructure, not vanity projects. If you're not gaming this out, your competitors already are. Ask your team Monday, what's our black effect? What's the asset that makes a creator think twice before jumping to the next platform-exclusive deal? All this works as long as the unit economics of audio stay sane. Next, we're going to talk about the video land grab, YouTube watch time, Ramesh going video first, and why SAG-AFTRA might be the unseen line item that blows up your let's just add camera strategy.
Okay. If segment 1 was the events are your moat play, this is the other structural bet. Are you going to underwrite video like it's TV while still calling it a podcast? Ramesh Ranganathan goes video first. Asha ships one-click YouTube imports, and every deck suddenly has a YouTube strategy slide. But the math is YouTube's math. Watch time, session length, search surface, not RSS, not downloads. The game is, how much free discovery will YouTube give you? And what does that inventory actually clear at once you're in their ecosystem instead of your own? In radio terms, YouTube is the national network. You're renting tower space. Great reach, terrible leverage. Here's what the press releases don't say. When you go video first, you quietly move into a two-tier market. You've got audio-led podcasts and video-led shows that happen to have an RSS feed. Those are not the same business. Tier 1, video native, studio sets, multicam, TikTok cutdowns, full-time editors. Tier 2, classic audio with maybe a static image on YouTube. The CPMs track that split. Video buyers will pay up for visual integration and branded segments, but they also expect TV-ish delivery, consistent schedule, higher completion, brand-safe environments. Meanwhile, your production budget just went from host, editor, maybe a producer, to small TV crew. If your audio show lived fine at a $25 blended CPM, does the math still math when you need $40 just to break even on the extra headcount and studio time? A lot of mid-sized networks are chasing YouTube because growth looks stalled elsewhere, but they haven't rebuilt their margin models. They're effectively subsidizing TV out of podcast P&Ls. And, plot twist, SAG-AFTRA is looking at this and saying, cool, you like video? Those look like TV sets. Those look like performers. Let's talk contracts. Once unions treat your podcast like television, your cozy independent contractor deals start to look very 2018. That's the underpriced risk. Everyone's obsessing over thumbnails and shorts, and the real grenade is, what happens to your cost structure when minimums, residuals, and working condition rules show up? If you're leaning hard into video and you haven't modeled what if my flagship talent suddenly falls under a SAG-AFTRA agreement, you're not doing strategy, you're doing vibes. The same way iHeart's Black Effect Festival is talent insurance, elite hosts are going to use this labor cloud as leverage. You want me in 4K on a couch 3 days a week? Cool. Price me like TV, not like a mid-roll. Which is the tell for where we're headed next. Sports, creators, agents. The podcast is no longer the business. It's the contract glue. Jeff Passan, Chris Williamson, Men in Blazers. Those deals are the blueprint. Okay. Let's zoom in from macro video wars to one vertical where this is all crystallizing. Sports. Jeff Passan re-ups with ESPN, but the headline isn't just kept the insider. It's that his Omaha Productions podcast is now explicitly part of the glue. That show is contract tissue. ESPN's not just buying baseball scoops. They're buying a multi-surface asset. TV hits, digital, social clips, and a pod that can spin into live shows or sponsorship bundles. The podcast is the upside kicker that makes the overall Passan P&L look better to the CFO. Same play on the agency side. Chris Williamson signs with CAA, and the pod is the centerpiece of his whole modern sports intellectual stack. You're not repping a podcaster there. You're repping a personality whose RSS feed is basically a deal origination engine. Books, speaking, brand partnerships, maybe docs down the line. Podcasts as leverage objects inside talent ecosystems. The show is the controllable surface where the talent owns cadence and framing. The rest of the stack, TV hits, brand work, drafts behind that.
Now, if you want the long art case study of what that compounds into, it's Men in Blazers, two guys doing niche Premier League nerd content. Fast forward, and they're a durable media brand. Live tours, merch, rights-adjacent content, betting integrations, sponsor packages that would have sounded insane in 2013.
Wow.
Here's what the press releases didn't say back then. Their IP aged better than most rights deals. The league experiments came and went, the MIB brand equity kept stacking. So, if you're a buyer today, PE, network, even a team, price that correctly. 5 years ago, you underwrote sports pods as hit-driven inventory. Now you have to underwrite them as compounding IP plus community plus optionality. Optionality is live events, shoulder programming around rights, sponsor category exclusives, maybe even data products. If you're not gaming that out, your competitors already are. The Rich Paul discourse is the same lesson. All that hand-wringing about his podcast credentials totally missed the point. The point is brand footprint and cross-platform leverage. When he talks, every sports desk in America writes it up. That halo is what you're paying for. Stop pretending you're pricing a neat little podcast. You're pricing a talent ecosystem where the RSS feed is just one node. Monday morning, the question is simple. On every sports show in your portfolio, do you have a clear map of the other surfaces, events, video, rights, categories that pod can unlock? If costs are marching toward TV, the only rational response is to unlock TV-level monetization surfaces off that audience.
Okay, let's land this. Triton's latest ranker has podcasts outranking talk radio for spoken word time spent. That's not a vibe shift. That's a baseline reset. If you're a planner, podcast isn't the experiment line item anymore. It's the default talk format. And here's the kicker. CNET, TechCrunch, the whole podcast ads actually work genre, they're basically user testimonials your CMO is reading on LinkedIn. Monday morning test number 1. Are you still pricing this like remnant radio or like premium addressable video without the waste? If Triton says time spent is there, and those case studies say lift is there, low 20 CPMs on high-intent shows, the math doesn't math. Pharma, financial services, B2B SaaS, categories where one conversion justifies a quarter's ad spend. Those buyers can clear 60 to 80 CPM all day. So, question 2, have you actually productized those categories? Not, we'll take pharma if it comes, but vertical packages, guardrails, and a deck someone can send today. If your sales team doesn't have a slide that says healthcare audio network, curated, brand-safe, opt-in audiences, you're leaving money on the table. And then attribution. This is where a lot of otherwise smart operators faceplant. If your only proof of performance story is vanity downloads plus a last-click promo code, you're signaling to big brands that you're stuck in 2018. So, Monday question 3. What's your attribution spine? Incremental lift studies? MMM-friendly log files? Cleanroom partnerships? Do you have anything your CMO can plug into their existing model? Once finance sees predictable uplift, budgets stop being experimental and start being required. If podcast is the new baseline for talk, 3 pressure points pop immediately. 1. Measurement. Firm. Triton and other rankers will get treated like TV currency. That means more scrutiny, panel versus census fights, and buyers demanding apples to apples across Spotify, YouTube, and OpenRSS. 2. Brand safety. As more pharma and Fortune 100 money shows up, we trust the host stops being a policy. You'll need block lists, sentiment analysis, human review on your tentpoles. And 3. Packaging. If you're still selling show-by-show IOs while competitors are selling sports fan dads across podcast plus YouTube plus fast, you're going to lose those RFPs. The operators best positioned here are the ones with real community, cross-surface distribution, and enough first-party data to stitch a story together. So here's the Monday homework. Ask your team, are we pricing like the new baseline? Are we proving it with credible measurement? And are we packaging audiences instead of episodes? If you can't answer yes to at least 2 of those, your 2027 earnings call is already in trouble. Follow the money, update the models, and stop treating podcasts like a side quest. It's the main campaign now.
Okay. We're going to land this plane. Remember when we broke down that headline, 24% podcast revenue growth at iHeart, and I said very calmly, some of that is just budget walking across the hallway from AM/FM into owned podcast inventory? That's the whole episode in one move. Follow the money, not the press release. The real takeaway in one sentence.
If you're not valuing community, video economics, and cross-platform footprint as one system, the math doesn't math, and you're mispricing both risk and upside. So, what do you actually do with that on Monday? 1. Look at your revenue mix and ask where growth is really just reallocated spend. 2. Map your top shows by audio-led versus video-led and price them like two different businesses. 3. Put community and events in the retention model, not the marketing slide. That Black Effect Podcast Festival? That's not vibes. That's a talent insurance line item disguised as a step and repeat. It makes it emotionally expensive to take the rival platform check. If you're not gaming that out, your competitors already are. And on the platform side, the YouTube push we talked about is basically everyone volunteering to play by TV rules while still pretending they run podcasts. Watch time, session length, search surface, not downloads, not RSS. If you're still sending decks that lead with monthly downloads, you're telling smart buyers you're stuck in 2019. Executives who win the next 12 to 24 months in audio treat this like a real channel with real pricing discipline, real talent economics, and real labor and union risk baked into the model. Everybody else is doing content and hoping CPMs bail them out. If this was useful, forward this episode to one person on your team who owns budgets, talent, or data. Bonus points if they argue with me. And if you want this kind of breakdown in your inbox, not just in your ears, make sure you're following the download so you don't miss upcoming deep dives. If you leave a rating or review, it actually helps the algorithm separate signal from noise and get this in front of more people who work in the space. If you've got reactions, deals you're looking at, or numbers that contradict what I laid out today, send them. The download at heymatto.com. I read it. All right, this has been The Download. Thanks for hanging out and going a layer deeper than the headlines. Well, take care, stay sharp, and I'll meet you back here on the next episode.